So today our unit is 16 and 15. Topic name is strategic planning and budgeting concepts, and the other unit is for the budgeting. Broadly, we are going to discuss two theoretical concepts. One is strategic management and strategic planning. Then what are the budget concept, how it helps the organization, how it creates motivation, it increases the performance. Then what are the budget methodologies, how we prepare the budgets, and then two broad classification in terms of operating budgets, which will include your all operations like AP, AR, account receivable, account payable, IC inventory control, and it is going to tell you how to prepare a sales budget, purchase budget, inventory control budgets, and these things. And then we have a financial budget. Strategic word when we use this is for the long term. Strategic planning and budgeting includes setting the direction of the company. Suppose you are based in US now, your company operation has increased, and people all over the world is giving you inquiries, and you are feeling that you should come out of US and you should make your office in Europe, in Middle East, or you have to cover the African market also. For that you have to take the strategic decisions based on your vision of the management, top management, owners, board of directors. That how they want to place themselves. Are they going to place themselves as a quality producer, the market leaders, cost efficiency providers? What is their vision to develop their company? Because everyone makes money out of their operating activities. Someone is more cultured oriented, some is more customer friendly organization, some don't care for the customer services but still they make money. So it all depends upon the strategic vision of a company, that how they place themselves in a company, in the world, positioning. And surely you should know your strength, weaknesses, opportunities and threats. That is a typical SWOT analysis that we do for all groups. For example, if as a CPA candidate you want to do your SWOT analysis, you will see your strength. That what is your strength. You are ready, you are a quick learner, or you are a sharp learner, or you have ability to study. This you consider as your threat, as your strength. Weakness, you might be feeling something that maybe 2 years, 3 years down the road, 5 years, you are out of education. So it will be a little, problem for me how I will study. This is internal weaknesses someone is thinking about. Now, these strengths, weaknesses, opportunity. If you develop yourself if you have managed to do CPA, the life is different, exposure is different, knowledge is different, behavior is different, personality is going to change, and job perspective is going to change. And what are the threats? Threats is if you don't have a professional qualification, might be if you lose your job, you will not get a new job. And if you are having one qualification but that qualification is not equivalent to CPA, then again it's a threat. But opportunities are there in the market that if you do this, your career change, everything is going to shift because it's a graduate degree. Same way for the companies, they have SWOT analysis. Suppose you are based in US, you want to come in Middle East. The first thing is your strength is you are a big company, you have big finance, you are not worried about sustenance, and your market name is already established, people know you. This is your strength. In fact, people are calling you for to come in this region. Example is CPA itself. That CPA has never been outside US, but all the people going to US to get the examination. So their positioning, branding, imaging is in a way that all the world is asking for to come outside of US. Same way, if you are Nestle, if you are McDonald's, you are KFC, you are Burger King, you are Procter & Gamble, you are any FMCG FMCG company, people know you. They want you to come. This is your strength. What could be the threats? Because you are a US company, you might be conceived as the, making money and not, you're not a social responsibility organization. People try to harm you because of the political and you can say the hateism they had if they have against US or the US government. Right? That's why most of the time, someone try to blast the US embassy or some, multinational organization like McDonald's, KFC. So these comes on the security risk. This is the threat that any expansion is looking for. And sometimes local manufacturers are feared from you because you are a big company. People know you more than their own brand. They want to have a made in US product. They want to have something which is more reputed. So once you go in that country, the local manufacturer will create a problem for you. Might be you will get problem in terms of availability of raw material. Then in terms of labor, unions issues might come. So these are all the threats that you have to see. And but opportunities are there because you are having a large economies of scale, your size, your financial economies, your technical economies, and your economies in terms of human resource efficiency, training and development is very high. So it will be a great success. It will be a learning for the market if cultured and high-tech technology you bring into a small region where they are not used to. It will be learning for that part of the world as well. So these things we have to keep in mind. So for expansion, you have a separate budget. For a contraction, you have a separate budget. Suppose we are based in US, we have Middle East operation. Now we want to make our factory in African countries. Say Burkina Faso, we identify which labor is cheap, land is cheap, we will go there. Now you need to spare more finances. So it will lead to a capital budgeting, long-term, long-term purchase, asset, equipment, IRR, NPV calculations will be there. This is for long-term assets, long-life assets. Now this budgeting is going to change the whole life of the organization. If you are in the expansion mode, then you need more finance, your capital asset pricing models, then your IRR, NPVs, then supported to this you have human resource budgeting, you need more employees, then you need more technology, more infrastructure. So all together it's going to change the operational part of the management. That's why when your board is seeking for a new business and when they call the CFO or the CEO, the first question should be that what they want to achieve, means what is their plan, how they want to. If you are a company based in US, you want to come out of US, then the first question is which area and what type of customers, what kind of vision that you have in the market. That will be discussed in the strategic management. Strategic planning, for this we have some tools, some theories like SWOT analysis, strengths, weaknesses, opportunities. Portal models are there. Budgeting concept, then will come what is a budget. Budget is also called as a profit plan. Budget can be in loss. You can budget the loss for 2 years and then 3 years, 5 years, it's up to you. Budget does not mean that it should be always a profitable budget. This should be a multiple choice question. You will see the CPA past examination that budget should be always a profit oriented. No, it could be 2 years, 3 years, 5 years loss as well. Depend upon the life of the project. If it is 20 years, first 4 years, 5 years is the seeding, research and development, and you are making your products, it's under development, something like that. 5 years it will be loss.